So I woke up this morning, 5:30 a.m., as I do these days, and, change a couple diapers, and it's actually quite fun to do that. And then, so I like The Economist. I don't read a lot of things, but I like that magazine because it's short articles, and I never have to read things more than 5 pages. So I quite like it, and I'm eating my oatmeal, and, I got my banana in there. So I look at capital expenditures predicted for the next 3 or 4 years, right? It's the latest issue of Economy. And then I'm thinking about Hans's comment about why aren't people putting money, and baby boomers are getting older and their risk appetite and so forth, and with that comment too starting to think about it. So guess where capital expenditures are being predicted for the next 3 or 4 years. I'll list them out for you. Okay, so you got internet, software, tech hardware, IT services, healthcare. Those are all predicted to have increases of somewhere between 40 to 60% increased spending over the next 3 to 4 years. Guess where the spending is going down? So, leisure, the good times, chemicals, oil and gas, metals and mining, property, maybe not in Vancouver, but property, and energy equipment. So let's not kid ourselves, the world's getting older. I saw CNN last night, or BBC, I love BBC. They're talking about Davos in Switzerland. Nobody invited us over there, but nevertheless, what's happening in Davos is supposedly the 4th industrial revolution, where robots are taking over the world. And robots are going to start, making us dinner and cleaning our bathrooms probably soon. So, I think money is going to be invested by the older population, but where? And so, therefore, it brings me to my very first point on my auditor's report. I'm not signing a report here, by the way. It's just my report today. So this is my audit. So technology, right? There's no doubt about it that every one of these industries is technology related. And whether it's healthcare, whether it's IT, there's all computers and handhelds, and the robots are starting to tell us what to do, right? I was having coffee with somebody earlier today. He's not here, but I was looking at his iWatch, and a meeting popped up, and robots are going to tell us what to do. And it's just happening, good thing, bad thing, up to you to decide. And so, and I think also about sort of the major issues that the speakers have talked about, impairments, oil and gas, emerging markets, and I try to visualize, if we're doing this presentation in 3 years from now, what are those issues going to be? And so I've got some predictions on that. And of course, we think valuations of IPs and valuations of technologies. We've got clients right now acquiring technologies. And so we're saying, well, what is it worth? I don't know how much time have you put on it, how many engineers did you have on it, and what is the valuation for it? What are your projected future cash flows? You walk to Gastown, downtown Vancouver, and you got lots of young entrepreneurs building all sorts of stuff out there. And they're getting some financings from Silicon Valleys, and valuations are high. And of course, somebody's rating $400,000, say, for 10% interest, and they're coming to us and saying, well, hey, our IP is worth $4 million. And that's what we would like to put on the balance sheet, please. And I say, okay, well, that's all right. And then, we do that, and we do a few procedures. And then, in a couple years' time, Hans is going to walk into our office, and he's going to say, well, I'm going to look at your audit file. And, what audit work did you do on that valuation? And how did you make sure impairment and so forth? So, a lot of today is speaking about what's happening now. And what the things we like to get out there in the message is what might happen later. So we're all mining people. Our business was built on mining a lot. A lot of people in the room are mining related. And we need to kind of roll up our sleeve a little bit and start to re-educate and retool, because these are the kind of issues that a lot of these speakers might be hitting on as we stand here next year and 2 years and 3 years and so forth. Technology. It's a nice house, Agriculture. So food, we all got to eat. I don't know. I've never met a human who doesn't eat. And, this city and the world is becoming healthier, which is good. We're all going on treadmills. We're all eating organic food. I personally don't understand what organic actually really means quite yet, because Costco sells a lot of organic stuff now too, and I thought Costco wasn't really organic, but it might be. So food is important, and land is scarce, particularly in North America, but also all over the world. And so we're starting to sniff out the agricultural deals coming along. And where that gets really interesting is, and we're going through some of this right now, where a number of clients are saying, well, guess what? We got this farm, and we're growing bananas, and, we're going to produce some nuts, and we think we're going to be able to have a crop for the next 50 years. And here's our discounted cash flow models. And guess what? This thing's worth $2 billion. And that's what we would like to put on the balance sheet, please, Mr. Auditor. And we're saying, well, okay, that's all right. We got to hire some valuators and we got to hire some people because, again, Hans might come to my office and he might say, well, you might not have done enough work on that. And I said, well, yeah, I did, Hans. I really tried. And then he might say, well, I don't think you did. And so I'll let Carla Marie know. And Carla Marie, and so on we go. And so agriculture, we think, is an area. And if you read that biological assets section under IFRS, you'll quickly see that when you have biological assets, which would be like a farm or a tree or anything that kind of grows, you put that at fair value on the balance sheet, not at historical cost. So of course, we're starting to see fluctuations, right? Up and down, it might be the lumber industry, it might be, and so forth. So watch out for those things, because again, maybe 3 years from now, we'll be standing up here and talking about why valuation of biological asset might be a big inspection finding and so forth. Thirdly, energy. And we don't necessarily just mean the holistic spiritual kind, although we think that's quite important too. Oil, let's not, did anybody think, like seriously, last year, did anybody think oil is going to go to this price? Did anybody? No? Okay, thanks for the honesty. I didn't either. I don't think anybody did. But energy is out there because we need it. I need it as I speak here, and we need to still fly things and ride things and so forth. And it may not be oil, but it might be solar, or it might be renewables. So energy is out there. We need it. We got to still drive and run around the city. So let's not think that that's not out there. So these are kind of the three areas that we see as opportunity, some risk too, because some of the issues surrounding these industries are the ones that might start coming to the forefront. I want to talk about business assets, and that's important and it's important in this room too, because you're doing a deal, sometimes you buy a company, sometimes you buy an asset, sometimes you do different things. And one of the biggest consideration is, did you buy an asset or did you buy a business? Here's why that matters. Because if you bought a business, and I'll get to that in a second, then that means you might have to produce audited statements, you might have to file a business acquisition report, and so forth. If you acquire an asset, then you don't have to do some of that stuff. Because you'd be saying, well, I just bought an asset. So here's my example. There are differences between the two. Here is what I would like to call a business. So a business in our accounting world is defined as follows. You got inputs. So you see there's people, those are people, those are inputs. You got processes. Well, I see, cars down the line, machines, things are happening there. And then lastly, you got outputs. Well, they're selling cars. That's a business. Now, it's a simple example. When you acquire something like this, you got to do audit of that business. However, if you acquire the car, then you just probably bought an asset. And to audit that asset, well, what'd you pay for it? Okay, what else is there to say about it? So, but there's big differences between the two. And that was a simple example because it's resonate hopefully with most people in the room. But let's take an example where you've got a mining company or you've got an IP, technology. We've got some friends down the street who have spent $10 million developing various tools and apps and online education things. And they think they're going to have major revenues and cash flows and so forth and all that stuff. And I say, well, is there a business here? Do you have customers? Do you have relationships? Or do you just have like an IP or a technology? So the fine line isn't always clear. And it's important whether or not that is. Carla Marie mentioned purchase price allocations. Okay, so you acquire a business, right, and you paid for it. You have to recognize not just the current assets and liabilities and recognize the goodwill. You have to identify the intangibles. And in technology, the intangibles are not confusing, but they're just different. Sometimes you have customer relationships. Sometimes you have future collaboration contracts with other people. So with technology and things like that, it's going to be really important, did you acquire a business or did you acquire an asset? You have the purchase price allocation issue. You've got the business acquisition report issue. If your purchase price allocation is no good and I didn't catch it for you, then Hans might say to me, well, what about that? And then again, he might tell Carl Marie, and Carl Marie says, well, what about that intangibles? And we get into a kind of a long, lengthy process. which, as mentioned, usually ends okay, but we want to avoid some of that in order to streamline things and get more efficient and so forth. So that's why business versus asset is important. If you acquire business, and you will probably tell you that you should file business acquisition reports, which includes audited financial statements of the business. Sometimes we get into situations where the business is a carve out of a big company. For example, let's say you've got a big global company and it's got 10 divisions. And it says, well, this division we're going to carve out into a separate public company. But we never really kept financial records of that separate thing. We just looked at the whole thing globally. So, and then Andy comes and says, well, you got to audit the business. And then, well, how do you audit the part that was just a part? And so it's not that simple, which is why it's important to figure that part out. A little bit on audit fees versus quality. We like to complain about that because, we think that regulation is still strong, in particular emerging markets. And sometimes I don't want to admit it, but they're kind of right. Emerging markets is for those who know consolidations, and again, Carla Marie doesn't always get to see the consolidations because he doesn't inspect the file, but Hans does. So let's not kid ourselves, okay? A lot of these trial balances in foreign jurisdictions are prepared for tax purposes, okay? And there's a lot of adjustments going through. Often, I'll be the first to admit, if I compare a trial balance of an emerging market company compared to the total consolidated balance, sometimes you think they're two different companies. So the reason why they're putting pressure on us to maintain audit quality is because there's a lot going on in between. And while money is tight and we get it, there are consequences of a failed audit. Okay, so if I don't get to do enough work because you grinded me on the fee a little bit and things like that, I'm trying to meet my budget, trying not to take shortcuts. We're doing our best, but the reality is that when we're grinded, we might make a mistake. And if we make a mistake, Hans might find it, and if he finds it, he tells Carla Marie, and it isn't that good for you either. So it's not good for me, it's not good for you, it's not good for them, because they don't really want to do that, right? They don't want to give people a hard time, but they need to meet their standards too. So the idea is that a failed audit does matter to you, not just to us and not just to them either. And I like the guy's suit, okay, I do, and I'd wear it too, maybe, for a Halloween party, but, we're not trying to say this is not quality, this is quality, but we do like to believe that quality in is quality out. So if we don't get a good product, it's hard for us to deliver a good report too. And then lastly, because I think so that's good for me to wrap that up, the relationship between us and the various regulatory industries. Sometimes, we have a situation with clients. Maybe we think there's a restatement. Maybe we think there's an audit issue. Us and you feel like we need to talk to somebody to ask something about something. And then you come to us and say, well, why don't you call the BCSC? And I said, well, I'm the auditor. I'm not management. You should call the BCSC. You should talk to them. Well, who calls them and who doesn't call them? And, and so as you can quickly see, there's a human face here. And so calling up the BCSC for guidance or for things is a good thing. Okay, nobody's out to get anybody. Everybody just wants to do the right thing. So there's nothing wrong with asking a question. We typically don't call the BCSC on your behalf. We're your auditor. We're not management. We talk to CPAB, as you know. CPAB doesn't talk to everybody in this room regularly, other than something like this. So we are the gatekeepers. We're kind of like the bouncer in front of that nightclub. You want to get into the nightclub? Here's a situation. You got to wear the shoes and you got to wear the suit. And if you don't do A, B, C, you can't get into my nightclub. So that's us. And we're getting sort of the pressure on both sides. So we talk to everybody, but we're sort of in the middle. That's that. So this photo, is in summary, and you mentioned it too. Everybody in this room, we're all in this together. If the public markets fail, it's not good for us, it's not good for you, it's not good for CPAB, it's not good for the BCSC, and it's not good for the TSX. So we're all professionals, and we all want to see a healthy industry, and part of our agenda here today is to show the human face of the regulatory body to let you know that we are here to help too, and we would like to see the markets continue to thrive and do well, and we're all going to do our job.